me ask you something. You wake up tomorrow and somehow, magically, $1 million lands in your bank account. What do? Most people, and I'm talking the vast majority of Americans, would pay off debt, maybe buy a house, get a new car, finally take that trip to Europe, maybe help out some family members. And within 5 years, that $1 million, gone. Studies have shown that a large portion of lottery winners end up broke within just a few years of their windfall. Not because they're stupid, not because they're lazy, but because they use the money the way they were taught to use money. And that's the problem. Because rich people, I'm talking genuinely wealthy people, not just high-income earners, they use money in a completely different way, almost an opposite way. And nobody teaches you this in school. Your parents probably didn't know it, and the financial system absolutely does not want you to figure it out. Today, we're pulling back the curtain. This isn't about hustle culture. This isn't about cut your avocado toast. This is about the fundamental structural difference in how wealthy people think about, move, and deploy money, and how you can start adopting these same principles no matter where you're starting from. Stay until the end because the last 2 points are the ones that most people never talk about, and they might be the most important. Let's get into it. All right, first things first. Before we talk tactics, we need to talk about the single biggest mental shift that separates how wealthy people think about money versus how most of us were raised to think about it. It comes down to one concept: assets versus liabilities. Now, I know, you've probably heard this before. Robert Kiyosaki wrote about it in Rich Dad, Poor Dad. But I want to break it down in a way that actually hits different. Because most people nod along to the theory and then go back to doing the exact same thing they've always done. Here's the simplest definition you'll ever hear. An asset puts money into your pocket. A liability takes money out of your pocket. That's it. That's the whole game. Now, here's where it gets wild. Most of what the American middle class is told is an asset is actually a liability in disguise. Your house? Most financial advisors will tell you your home is your biggest asset. But think about it. Does your house put money into your pocket every month? Or does it take money out? Mortgage payment, property taxes, maintenance, insurance, HOA fees? For most homeowners, the house is a cash flow negative. That makes it a liability by definition. Now, yes, it might appreciate in value over time, but appreciation is not cash flow. It's a bet, and until you sell it, that wealth is just a number on a screen. Your car? Definitely a liability. Cars depreciate the moment you drive them off the lot. The average American spends over $10,000 per year on vehicle costs. That's according to AAA's annual Your Driving Costs study. That's money leaving your pocket every single month. Even your college degree, while valuable, comes with debt that is very clearly a liability. Now compare that to how wealthy people approach this. A wealthy person buys a rental property. Every month, rent comes in. After expenses, that property puts cash in their pocket. That's an asset. A wealthy person buys stock in companies that pay dividends. Every quarter, checks arrive. Assets. A wealthy person buys a business or invests in one. That business generates revenue whether they show up or not. Asset. The rich spend their money acquiring assets. The middle class spends their money acquiring liabilities and calls them assets. And this isn't about income level. This is about priorities. There are people making $200,000 a year who have zero assets. And there are people who started with almost nothing who have built significant asset portfolios by making this one mental shift. The question you should be asking about every major purchase is not, can I afford this? The question should be, does this put money in my pocket or take money out? Here's a phrase I want you to write down or screenshot right now. Rich people don't spend money. They deploy it. What's the difference? When you spend money, it's gone. You hand it over, you get something in return. A meal, a shirt, a vacation, and the transaction is done. The money has left the building. When you deploy money, you're sending it out on a mission. You expect it to come back and bring more with it. This is how wealthy people think about nearly every significant financial decision. They are always asking, what is the return on this? Now, let me be clear. Rich people absolutely enjoy their money. They take vacations, they drive nice cars, they eat at great restaurants. But even those decisions are filtered through a different lens. Let me give you a concrete example. A middle-income earner gets a $20,000 bonus at work. Here's what typically happens. They pay off the credit card, maybe put a little in savings, and feeling like they've been responsible, treat themselves to a new TV, some furniture, maybe a vacation. By end of year, the $20,000 is gone. A wealthy person or someone building wealth, they take that $20,000 and they ask, where can I deploy this for maximum return? Maybe it goes into index funds. Maybe it's a down payment on a rental unit. Maybe it funds a side business. Maybe it's used to learn a high-income skill that generates $50,000 more per year going forward. The money doesn't disappear. It gets assigned a job. Warren Buffett, one of the wealthiest people on the planet, famously still lives in the house he bought in 1958 for $31,500. Not because he can't afford more, but because he understands that every dollar he doesn't spend on lifestyle is a dollar that can be deployed to generate more wealth. Now, you don't have to live like a monk, but the wealthy understand something called opportunity cost. The idea that every dollar you spend on one thing is a dollar you can't deploy somewhere else. So the question isn't just, is this worth X dollars? It's, is this worth more than what else I could do with this X dollars? That shift in thinking changes everything. Okay, this one is going to blow some minds because we're taught, especially in America, that debt is bad. Dave Ramsey has built an entire empire telling people to avoid debt at all costs. And for certain types of debt, he's absolutely right. But here's the dirty little secret. Wealthy people love debt, just not the kind you're probably thinking of. There are two types of debt. One, consumer debt. This is the debt most Americans carry. Credit card balances, car loans, personal loans for vacations or furniture or medical bills. This debt funds liabilities. It takes money out of your pocket in two ways, the original purchase and the interest payments. This is wealth-destroying debt. Leverage? This is the debt wealthy people use deliberately and strategically. It funds assets that generate returns greater than the cost of the debt itself. Let me break that down with a real-world example. Suppose a wealthy real estate investor takes out a $500,000 mortgage at a 7% interest rate to buy a rental property. The property generates $60,000 per year in rent. After mortgage payments, taxes, insurance, and maintenance, there's still $15,000 in annual cash flow. Plus, the property is appreciating in value, and the tenant is essentially paying down the mortgage for the investor. That's leverage. The bank's money is working for the investor. The average American, meanwhile, carries nearly $8,000 in credit card debt at an average interest rate of over 20%. They're paying the bank for the privilege of having bought things that are either gone, restaurants, vacations, or depreciating, electronics, clothing. Rich people think of debt as a tool. Like any tool, used correctly, it builds things. Used incorrectly, it destroys. And here's something else that will make your jaw drop. The ultra-wealthy use a strategy that financial professionals call buy, borrow, die. Here's how it works. Instead of selling their investments, which would trigger capital gains taxes, wealthy people use their investment portfolios as collateral to borrow money at very low interest rates from banks. They live on those loans, which are not taxable income. Meanwhile, their investments keep growing. When they die, their heirs inherit the assets with a stepped-up cost basis, meaning a significant portion of capital gains taxes disappear entirely. Elon Musk, Jeff Bezos, and Larry Ellison have all reportedly used variations of this strategy. They're not spending their wealth, they're borrowing against it. And the tax code, written significantly by and for wealthy people, makes it completely legal. That's not luck, that's a completely different system of using money.